All right, everybody up. Up, up, up. I'm not kidding. Need help? Need help? All right. This venue's a little bit steamy. It's mid-afternoon. We're a couple sessions away from good German beer. Is my mic on? Let's go. We're gonna do a little exercise. Not physical exercise, because I don't wanna hurt anybody. But I just wanna get a sense for where the optimism is in the room versus where it was like a year or so ago. So when I get to the high by the end of 2020 in the price of Bitcoin, I want you to sit down, right? So basically the last person standing needs to be the greatest bull in the room. And I want to see if we can get like a top tick prediction on what's going to happen in the next like 12, 24 months. All right, so if you think that the high in the next 24 months is going to be $20,000, all right, that's how you know we're at Web3, because people are already sitting down. All right, 30,000, 40,000, 50, 60. This is by the end of 2020, so about 17 months. 17 months. All right. Did I say 60? 70? 80? What's that? I'm weeding people out. Is anyone left standing? Are you just in the back corner? Who is the last one standing? One? Okay. Well, you're way too far. I was going to have someone just talking to my microphone and give the investment thesis. But anyway, okay, you can sit down. Thank you very much for being a bull. I think it's going to go to 100,000, but that's just me. So hope you enjoyed that little stretch. I know everybody's been sitting down for a while, a lot of good presentations. Those who don't know me, my name is Ryan Selkis. I'm the co-founder and CEO of Masari. We're a crypto asset research and data company. And our whole shtick is transparency and data standards in this industry. So I'm going to talk a little bit today about building trust, transparency in Web3. And I also have a bit of a challenge for anyone that's building a protocol, is building a bit of infrastructure that interfaces with users and who has users that are going to need better information and education tools as they come up to speed on this market. So as you can tell from that original exercise, we are all in on crypto in general. I think that this is going to be a $10 trillion asset class in the decades to come. It's not going to be a straight line up, but we are just getting started in terms of what these decentralized protocols can do, just getting started with the very concept of DeFi and programmable money and what impact that could have on lending markets, derivatives markets, all new type of synthetic securities and mutualized risk pools. And we couldn't be more excited about the trajectory of this entire asset class. I do think, though, that most people get a little bit ahead of themselves. We saw this in the last bull run. We thought everybody was comparing these assets to Bitcoin. Not everything in Web3 is money. More recently, we started to think about utility tokens. Well, not everything is a utility token. There are now work tokens and burn tokens and other mechanisms like Binance that kind of look like quasi-securities. And then we've got this whole mass of new products like Maker CDPs and Compound and DYDX derivatives that are the very beginning of the layer 2 financial products for this new financial system. And we do think that this is going to be as transformative for finance as the internet was for publishing. But one of the primary gating items is that most people don't trust these technologies. The taste that most people outside of this room have from DeFi and the token economy in general is still the 2017 ICO bubble, which I think most rational people would say was completely ridiculous. And the question that I'd present today is, to a certain extent, are we approaching the growth of the system in the same way that we did in 2013, which is indiscriminate? I certainly hope not. But in order to get a better sense on where the value drivers are going to be and where the real value is going to be in Web3, we have to do a couple things. One, we have to improve the standards around transparency and level the playing field for all new investors. Right now, this is a market that is driven by the token teams, the asset creators, and then crypto funds. And in fact, as I'm going to show in a few slides, I think almost all of the value creation in protocols after Bitcoin and Ethereum is actually going to accrue to private investors and funds versus individuals. What's that going to do for communities and actual user engagement? The second thing that I think we have to do a better job of is enforcing data standards, right? So even if you look at something as simple as spot price or volumes on all of the centralized exchanges, we all know what a mess those are, how manipulated those metrics are. They're wash trades and other manipulative trading practices that inflate these numbers. And you might say, well, it doesn't really matter. You're talking about, a little bit of shady activity here, and maybe the volumes are inflated, but the spot price is generally correct. Well, that may be somewhat true until you start thinking about layer 2 applications. And really, for me, DeFi and Web3 and some of the applications you can build on top of these base layer protocols are only going to be as structurally sound and as interesting as the data that actually pipes into them, right? So if you think about an on-chain derivatives contract or an on-chain lending product or what the liquidation price should be on a maker CDP, all those things are going to rely on much more robust and reliable data infrastructure before anybody really takes this asset class seriously beyond just a speculative bet maybe on Bitcoin and Ethereum if you're an institution. And then lastly, I think we need to do a much better job in curating research, because this is an asset class that's getting built out in real time, right? So the experts are not necessarily the media companies, are not necessarily the professional researchers. They're in many cases the folks that are building these applications and these protocols in real time. How do we consolidate all of the news and information in a curated way so that we can elevate things that might happen on Telegram and Twitter and Medium and Slack, but don't necessarily have a home that people can refer to if they're looking for a single source of truth with many of these assets? And in fact, that's a lot of what we've been working on at Messari. So if you look at every single major asset class, every single major market, whether it's insurance or real estate, of course, financial services, Bloomberg and S&P and FactSet are the companies that typically come to mind. They all do one thing really well. They all aggregate information and different types of data, qualitative, quantitative, and they bring it into context for whoever the primary consumers of that information are. We have no such thing in this industry. There are some other very good teams that are working on this problem in addition to us. But I think what's different is the bias is always to package this type of information for an enterprise buyer, for a fund, for an institutional investor or limited partner, for someone with a lot of money that's going to be able to pay for this type of research. And what makes us a little different is that we're saying some of this basic biographical information, some of these key metrics around supply, price, KPIs on a project-by-project basis, some of the key items that you need to be aware of from the governance of the project, from the technical roadmap and how that conversation is evolving, these need to be open and accessible, and there needs to be at least a starting point for any investor, any individual that's going to be entering this ecosystem to have this common set of information to be able to benchmark assets against each other. And what our primary goal is to build out this robust public utility and public library of information so that anyone, including our competitors, can pull some of this base level data, and we can ultimately finally speak a common language and develop a single source of truth for this asset class. I fear that we are doing nothing of the sort at a macro level. And in fact, I think I'd go so far as to say that the game is completely rigged, and that for all the aspirations of this industry, the current state of the token market is no better than the public equities markets, in the sense that almost all value is going to accrue to the asset creators or issuers and the crypto funds that have been spun up and incentivized to invest in them early, get preferential deals, and they're highly incentivized as fiduciaries to exit those investments to less sophisticated investors as they list on exchanges. I'd say the exchange's primary customer isn't necessarily even their users, it's the market makers and the funds that are going to need liquidity on these investments. And you can kind of see that in the sense that none of the major exchanges right now have information resources on top assets that are meaningful at all if people are trying to do research at the point of order execution or at the point that they're purchasing these assets for the first time, ostensibly to use them and not just speculate on them. And then finally, I think even with the asset creators themselves, the well-intentioned projects might be good about transparency. The well-intentioned projects might be very above board about how they're thinking about long-term value alignment, incentive alignment with all their stakeholders. But the problem is it's not trivial to aggregate that in one place or even more challenging, to make sure that that type of ubiquitous disclosure is publicly accessible across all of the dozens of exchanges and other information aggregators and other application providers where this information might be useful to have directly for the users that are engaging with these systems. If you think about this, this is layer one we're talking about, right? This is kind of killer app number 2, asset issuance or ICOs in this distributed investment bank. The creation of these assets is still a black box. So how do you think new users are going to feel about a layer above that, above these native protocols and how they're engaging with DeFi applications and other synthetic financial instruments that are sitting on top? And I want to drill down on maybe the most salient bit of research that we've done at Messari over the last couple of years. And I think, in a sentiment-driven market, maybe one of the only fundamentals that really matters, which is, are you growing demand for your protocol token, for your assets, faster than you are inflating the supply? And the advantage that many of the ICOs had in 2016, 2017, and beyond is they built in artificial scarcity from the onset. And instead of having programmatic inflation, many of them just said, we're going to unwind this over time. But we're not going to flood the market. We're not going to dump our tokens on the market. But we're just going to be smart about our treasury management and make sure that these assets get into as many hands as possible over the course of several years. So before we think about Web3 and competing smart contract platform tokens, let's just take a look back at what happened in the currency markets. So XRP, XLM, Lumens, and Zcash, 3 prominent examples. You might know that the headline number of tokens that will ever be available for Ripple's XRP is about 100 billion. Stellar, more or less the same. Zcash is predictable. It's nice. It's all programmatic. It's 21 million. But the issue with all 3 is that if you look at how much has been reserved and how much has been gradually liquidated, even from these pre-mined treasuries that the first 2 projects have, if you wanted to compare these apples to apples and just think about the liquid inflation rate, which is the second to last box, it's about 25% per year for XRP, which is equated to well over $1 billion over the course of the last 8 or 9 quarters. For Lumens, it's closer to 67%, right? They do an airdrop or an earn.com campaign with Coinbase in the hopes of distributing this token widely. All that is inflation and ultimately dilution for the existing holders of XLM, and it's not really necessarily growing the organic demand of that asset. And then with Zcash, it's one of the most atrocious charts in the industry because there is this persistent daily issuance and sell-side pressure that puts Zcash in the top 5 assets by daily issuance. And almost all of that is getting sold by the miners in Zcash that have to pay for their electricity bills. So that's been reflected in the returns over the course of the last 18 months. And this is in Bitcoin terms, right? 70% down for XRP, 80% down for Stellar and for Zcash. So I think it's important as a benchmark, even something as simple as supply, which is 1/2 of the market cap calculation that many people think of as the primary metric of network health. A lot of Web3 application tokens could be in for a bad time. So that last slide was pretty bad if you're an investor. And I know not everybody is an investor. You want to build these for users. You want to make sure that the folks that are actually dabbling with these technologies, the goal is ultimately to abstract all of this economic backdrop away for certain applications. But the fact of the matter is the killer app in this industry is speculation. It has been, it probably will be for the near and medium term. And I showed you the performance metrics on the last slide for some of those centralized currencies. The dynamics for Filecoin, Polkadot, and Telegram are actually worse in terms of initial centralization. Not only from the project teams, but these teams have collectively raised $2 billion in investor money, about $2.5 billion, which is actually more, significantly more than the 3 currencies on the previous slide. So not only do you have the backdrop of the founders and project operations reserves that are being held by some of these assets in the hopes of incentivizing their teams, funding development, striking partnerships, building allies, but you've got a massive sell wall that any user in this ecosystem is going to have to get comfortable with. And I would argue that Bitcoin and Ethereum are successful, in large part, if not almost solely, because the users and the folks that ultimately maintain the system early on got fabulously wealthy and rewarded. There is no such dynamic that's coming in the years ahead for some of these other Web3 applications. It's just simple economics. So if you think about what that ultimately means, that's a pretty grim picture, and I promise I'm a very pleasant person otherwise, believe it or not. But it's one of the reasons that we created this disclosures initiative at Messari, right? So you think about disclosures, you think about something like Edgar in the securities market. It's probably the driest, most boring possible application you can think of in a market that is as exciting as crypto. But in reality, if you don't have some type of engagement with the asset creators, you don't have some way of engaging with all these key stakeholders in these new emerging protocols, and you can't get some conviction that they're going to be smart about how they unwind these treasuries that they hold over time, how they think about programmatic inflation, how they think about constraining the selling pressure that is borderline inevitable for these systems, it is going to be very, very, very difficult for any of them to build an organic user base of holders and people that are bullish, because it is very tough, even if you're only in this for the technology, which everybody likes to lie about. Even if you take that rosy assumption, the reality is that most people do not like losing money month over month, year over year for many years. And I think this is one of the biggest network effect advantages that Bitcoin, certainly on the currency side, and maybe Ether have today. It's not to say that it's insurmountable, but this is probably the one thing that we look at for teams that are thinking about new incentive models and new ways of bringing these crypto assets to market. So, we're pleased that we've now worked with 55 of the top projects, the top 400 or so projects in the industry worldwide over the course of the last 8 or 9 months since we launched our registry initiative. And they're working with us to give us this sort of basic information about their governance, about their treasury policies, the core people associated with the project, and trying to be a little bit more methodical and smarter about how they think about the super long term from an incentive alignment perspective and how they actually communicate with their stakeholders. Today, we're thrilled to welcome, this says 12 because I can't count, 10 new additions. I wrote this middle of the night last night, jet lagged. Acropolis, Beam, Cardano, Elrond, Fusion, Helix, Keep, Lisk, Orbs, Permission, and vSystems, and are just getting started. We have another dozen or so projects that we think we'll be announcing in the next 6 weeks or so, and hope to have about 100 by the end of the year. That's phase one, right? But like I said in the middle of the presentation, the most important thing for us, and I think for the industry, whether it's us or someone else, is to make sure that some type of public utility, some type of basic information that is consistent, that is reliable, that any other third-party information resource or independent analyst or regulator or exchange can access and build on top of is going to be critical. So the call to action that we have and our primary focus the back half of this year and probably for many years to come is going to be making sure that the information that we are collecting, the information that we are standardizing becomes ubiquitous across the industry and is ultimately available for users when they need them so that they're coming in with a fully baked opinion and informed investment decision, whether it's a direct financial investment or whether it's an investment of their time as a developer or a partner or a stakeholder in any other respect. So I think I have time for one question. If anyone has the best question in the room. Maybe the guy that called the top tick in price. Theater, so it's going to be someone that has to have a loud voice. So stand up and project because I don't think we have a mic. Yeah, you. Mm-hmm. We have a flat annual fee that we charge the projects that are on the registry, and it's one of the reasons that we've intentionally stayed away from rating assets or doing anything that would look like sell-side research and making buy, sell, or hold recommendations. So the best way that you can think about us, I know no one wants to make the public market comparisons, but Broadridge in financial services handles governance communications, proxy filings, and generally does a lot of the grunt back office work that interfaces with investors, broker-dealers, and other regulated parts of the existing financial system. So I would say that we would like to fill that goal in the crypto market so that the SEC, at least in the US where we're based, does not just crack down on everything, and we can at least help people self-regulate and abide by the spirit of existing consumer protections laws. 15 seconds. That one I couldn't hear. Say it again.
Do you guys have any information on illiquid assets, as well as liquid ones, like how the sale was conducted, how the tokens are vested,
yes,
prices and whatnot? Because I couldn't find anything on that.
Yes, so we do have basic information that's going to be available through our Pro products. So that is one thing that we will paywall, the illiquid assets that are trading OTC. The reason for that is because technically they're only supposed to be available for professional accredited investors anyway. So our goal is to make everything free and open source for the liquid products that you would see on the exchanges worldwide. But we do have some of that private market information as well. And in fact, we think about playing an important role, I hope, in the introduction of these assets onto exchanges like Binance and Coinbase Pro, et cetera. Great. Thank you, everybody.